Hi, my name's Jared Rogers and I'm from Beyond Accountancy. Welcome back to the channel. In today's video, I'm going to answer the question, should I pay my help debt early? So help debt, as you probably know, is a student debt in Australia issued by the government that you repay based on your income. If you earn less than $48,000, you don't have to pay anything off your debt, and it can go as high as 10% if you earn more than $141,000. To see the full table, go to the ATO website, ato.gov.au, and search for the number on the screen. So by way of background, when does your help debt change? Well, if you have a help debt, you'll know that, say you get paid every fortnight, or on each fortnightly pay slip, you'll see a deduction for help repayment. So you'd feel like throughout the year, fortnight by fortnight, your debt will progressively drop. But that's not actually how it works. If we take a year, you'll see that your help debt only changes twice. So in June, on the 1st of June, in fact, your help debt rises due to indexation, which is an adjustment for inflation. So your debt will go up. And then later in the year, when you do your tax return, normally around August, September for most of you, your debt will go down by the compulsory repayment amount that we saw in the previous table. So in actual fact, your help debt doesn't change despite the fact you're paying it every fortnight. So it goes up once, it goes down once, and for the rest of the year, it does nothing. So where does that money go every fortnight if it's not coming off your debt? Well, it just goes as a tax credit along with the rest of the tax that comes out of your pay. At the end of the year, that credit covers the compulsory repayment, which is triggered by lodging your tax return. So why does the timing matter? Well, because indexation only happens once and it's based at a point in time. So if you look on the ATO website, they say that indexation is applied to the part of an accumulated study and training loan or help debt that has remained unpaid for more than 11 months. So it's based on your debt just before indexation is applied. So if you clear your debt in mid-May, your indexation amount will be nil, even if you had a debt for most of the year, from 1 June to 31 May. So the key point here is it makes sense to make voluntary contributions in mid-May. So I'm not saying you ought to make one, I'm saying if you are going to do it, mid-May is the time to do it. So what are the factors to help you make up your mind? Well, what else do you need the money for? Once you've made the repayment, you can't undo it. So if you needed the money for a home deposit or to purchase a car or anything else, you need to consider that because you can't change your mind and have it back. Are you likely to ever pay it off? By that I mean, are you ever likely to pay off your help debt? So if you think you'll consistently be on a lower income, say $50,000 or so, or you're coming towards the end of your working life and you're on a low income, so you're going to be below the threshold, then it might not be worth paying the debt because your help debt dies when you do. That is, it doesn't form part of your estate like a mortgage or a personal loan might do. It's just waived. And so paying it off voluntarily might be just wasting your money. How many years will it take to pay the debt without voluntary repayment? So how many tax returns would you need to lodge now and into the future to trigger compulsory repayments? So if you're 2 to 3 tax returns away from clearing your debt, then it's much more promising or much more likely that you could pay the debt as a lump sum versus if you've got 10, 12, 15 years before you'd pay it by lodging tax returns. And finally, what is the rate of indexation? That's really important. So just briefly, look at the historical rates there on the screen. You can see it was very low for a number of years from 2017 right up to 2020. In 2021, it got even lower because of the lockdown-induced recession, and then it bounced back up. So we don't know what the 2023 number is going to be, but we know what inflation is for 3/4 of the year. We're just missing March 2023. Once that gets released, we'll know. Let's say it's 7%, which it looks likely to be if you look at the previous three. It's probably going to stay there for another 2 or 3 years after that as well. So 7% is pretty much guaranteed unless something dramatic changes in the economy in the next, say, 6 to 7 weeks. Why is that important? Because for 2021 and the years prior to that, your help debt was lower than your mortgage rate. It was lower than your online saver. It was just not an attractive enough rate. It wasn't worth making voluntary repayments, because why save less than 2% on indexation when you could be saving 3% plus on a mortgage? But that's all flipped around due to the high inflation. So for the first time in many, many years, your help debt is higher than both a mortgage rate and a savings rate. So just pure maths, there's more benefit of paying the help debt. Again, you might need the money for something else, in which case don't do it, but the percentages actually add up now. So let's take a hypothetical taxpayer with a salary of $150,000 a year, help debt of $26,000. She's got enough in her mortgage offset to clear the debt, and let's say she's paying about 5% on her mortgage. I've got a little spreadsheet which I'm going to use to calculate what the benefit would be of paying it versus not paying it as a lump sum. So here's my spreadsheet. I'll put the link to that in the description. It'll be uploaded to our website. You only need to enter data in the green boxes. Right, so the rest are all going to be based on formulas. So the rate of indexation, I've put an estimate of what that might be. But if you're doing this in May and the ATO has since published the rate, you can update that box there, but it's going to be pretty close. So ignoring that part, all you're going to need to do is put in your salary, the debt, and the rate of a mortgage. If you don't have a mortgage, then you want to compare that to the rate of savings, because that money is going to come from somewhere, right? So it's going to come out of an online saver, and say you're making 3%, then you'll put 3% in this box. So we're trying to work out a comparison of what you would save in indexation versus what you would pay in interest. So in option one, let's say you pay it off in May 2023. Well, you're going to incur interest over time because our taxpayer here, she's got a bigger mortgage now because she's taken out the $26,000 from it. That's going to cost her interest, but she'll avoid indexation. So the net cost is $500. If she just leaves the money in her mortgage, she won't pay any interest, but she'll have to pay indexation twice. So once this year, and then again next year. Next year will be smaller because her debt will be lower because you'll be doing her tax return in August. But nonetheless, she's $2,000 better off. So even factoring the extra interest on the loan, this taxpayer is $2,178 better off by clearing her debt in May this year rather than waiting for her next 2 tax returns. Now, if she was planning, for example, to have a career break and go and study or have babies or whatever it might be and be on a low income for a while, well, that would change this entirely. If her intention would be to work full time from now to, say, this time next year, that would be enough to put her in a high enough bracket that this would work. This calculator only works if you're less than 3 years away from clearing your debt. What works best in that situation. So finally, what if you do decide to pay off the debt? Well, there's 2 important things you should do. The first one is to tell your employer they no longer need to deduct help repayments from your salary. Right, so your take-home pay will be higher, and you can use that extra take-home pay to fill up that mortgage offset account or that online savings account, wherever you got that money from. There'll be a chance to pay that back. If you decide, for example, you might borrow that money from the bank of mum and dad, so you can avoid indexation, you can use the extra take-home pay to pay back mum and dad. That's actually quite a good way of doing it. You could pay them an interest rate. It'll be much less than the 7% on the HECS debt. Might be even less than you would get from a bank. So but use the extra take-home pay to pay off whatever debt you used. But you have to tell your employer, I no longer have a help debt, so they know to do that. And the second thing is to lodge your tax return as soon as possible. Because if you've been paying extra tax throughout the year to cover a help debt, you will be doing that for up to 10 months, say from July 2022 to April 2023. You're paying all this extra tax, but you don't need that extra tax to cover your help debt repayment anymore. So what happens to it? It goes back into your pocket. It gets added to your normal tax refund. So if you have been paying HECS through payroll the whole year, then you clear the debt in May, you can expect thousands of dollars more in your tax refund for this year than you'd otherwise get, and therefore you should lodge in mid to late July or as soon as you're able. So here's the summary. If you want to make voluntary help debt repayments, mid-May is the ideal time. You can't undo that decision to repay, so make sure you're confident you're not going to regret it. It makes more sense to clear your help debt if you're 2 to 3 lodgements away from clearing it anyway. And if you do clear it, remember those 2 actions: tell your employer and lodge your tax early in the cycle, late July next year, or so this year, next financial year. Hope you enjoyed this video. Please hit like and subscribe if you haven't already done so. If you're not already a client of ours and you'd like to be, you can get in touch via our website, beyondaccountancy.com.au. Thanks for watching, and I'll see you next time. Goodbye.